Lower oil prices are great for the consumer, good for overall GDP growth, but the fact that we've seen such a magnitude in the fall of price, people are calling it the reverse oil shock, where's it come from? So it's basically a supply-demand issue. So does slowing demand for oil mean that the global growth environment isn't as positive as people thought it was?
So at this point, investors are still trying to digest what it would really mean for the bottom line of companies and for the future of the stock market.
Exactly, and people are debating this current price around $50 a barrel. Is it the ceiling or the new floor?
All right, you are going on an investment roadshow from Hong Kong to Singapore to Bangkok and Europe next month. What will be some of the key themes that you will be telling the investors?
So in terms of emerging markets, and let's look at oil again. So lower oil prices.
It all goes back to oil.
Well, it's one key factor. Lower oil prices, it's not great for net exporters of oil, such as Malaysia, such as Australia. And in fact, Australia, I mean, when you look at the Australian economy, they never went through a recession during the global financial crisis because they're resource rich, because there was demand coming out of China. So they had this massive commodity relating spending boom. In fact, jobs in Australia relating to the mining industry, we saw an increase. A truck driver who works 3 weeks out of 4 in Australia earns about $240,000 per annum. So if commodity prices get derailed, that's bad for the Aussie economy. For places like China and India and Thailand, because we have this huge reforms agenda by the government that really need to be implemented, a lower inflationary environment means that they can actually implement their reforms and their easing if they need to.